Ladies and gentlemen, we are now 48 hours away from the largest coordinated sovereign debt collapse in modern financial history. My name is known in the circles where truth is spoken behind closed doors. Today I bring you that truth. It is Tuesday, January 13th, 2026. The clock reads 12:36 Moscow time. And while the world sleeps, while markets hum along pretending everything is normal, a financial earthquake is building beneath our feet. The tremors started months ago. The cracks became visible weeks ago. But the collapse, the actual moment when the ground opens up and swallows entire economies, that moment arrives this Thursday. What I am about to show you is not speculation. This is not theory. This is mathematics. This is blood on the balance sheets of nations. This is the moment when the entire architecture of emerging market debt, the very system that has kept developing countries borrowing and developed countries lending for 50 years, shatters into 1,000 pieces. Here is what they are not telling you. The sovereign debt market has fractured. It has split into two completely separate realities. There's the price you see on Bloomberg terminals, the yield spreads published by financial news networks, the credit ratings issued by Moody's and Standard & Poor's. That is reality number one, the official reality, the lie. Then there is reality number two, the real world, where developing country finance ministers sit in darkened offices at 3 a.m, staring at spreadsheets, knowing with absolute mathematical certainty that they cannot make their next debt payment. Where central bank governors pick up encrypted phone lines to Beijing, to Washington, begging for emergency dollar swaps that will never arrive. Where the interest payments do exceed, not by a little, but by magnitudes, the actual foreign currency reserves sitting in their vaults. These two realities, the screen reality and the vault reality, they used to be connected. Arbitrage kept them aligned. If bonds traded too cheap relative to fundamentals, buyers would step in. If they traded too rich, sellers would emerge. The market was a single organism. One price, one truth. That organism died 3 weeks ago, and most of you do not even know it yet. The screen still shows prices. Bonds still trade, but those prices, those trades, they're ghosts. They're the memory of a market that no longer exists. Because the bridge between what the screen says and what is actually possible has been burned. Let me show you the 3 tiers that have emerged. 3 completely separate debt markets, operating at wildly different prices, with no mechanism to bring them back together. Start with Zambia, African nation, copper exporter, population 20 million. They defaulted back in June of 2020. That was nearly 6 years ago. 6 years. And they still, to this day, have not reached a final agreement with all their creditors. Their bonds, the ones that officially trade in London and New York, those bonds are quoted at 32 cents on the dollar. 32 cents. That is the screen price. That is what Bloomberg will tell you a Zambian government bond is worth. But try to sell a large block. Try to move $10 million worth of Zambian debt. You know what price you will actually receive? 18 cents. 18 cents on the dollar. That is tier 1. That is panic. That is the price where the only buyers left are vulture funds and distressed debt specialists who know, with certainty, that they will spend the next decade in litigation trying to extract anything from the carcass. 18 cents is not an investment. 18 cents is a bet on the court system. It is a gamble that you can seize a presidential airplane or attach a cargo of copper at a European port. That is not a functioning debt market. That is financial warfare. Now, a move to Sri Lanka, island nation, 22 million people, tourist destination turned debt disaster. They declared bankruptcy in April of 2022, stopped paying external creditors, announced restructuring. That was nearly 4 years ago. Their bonds trade officially at 47 cents on the dollar. 47 cents. Better than Zambia, right? Sounds like there is hope. Sounds like maybe, just maybe, creditors will get half their money back eventually. But here's what the screen does not tell you. There is zero, and I mean zero, actual liquidity in Sri Lankan debt. You can see a price. You cannot execute at that price. The last real transaction where actual cash changed hands for Sri Lankan sovereign bonds, happened 8 months ago. 8 months. The 47-cent quote is a phantom. It is a dealer marking his position at whatever number keeps his risk management system from blowing up. But there is no bid. There is no offer. There is just a number on a screen that has no connection to reality. This is Tier 2, the frozen middle. Assets that appear to have value, but cannot actually be sold. Then we have Tier 3. This is where it gets truly terrifying, because Tier 3 is not the countries that already defaulted. Tier 3 is the countries that are about to default. The countries standing on the edge. The countries where everyone knows what is coming, but nobody wants to say it out loud yet. Ghana, $70 billion in total debt. Debt to GDP ratio 105%. They restructured domestic debt back in 2023. Cut payments to local banks and pension funds. But their external debt? Still outstanding. Still accruing interest. And their dollar reserves? Falling. They have enough foreign currency to cover maybe 90 days of imports and debt service. 90 days. That is Tier 3. Ethiopia. Same story. They restructured with the Paris Club. Got some relief from bilateral creditors. But the commercial debt, the Eurobonds, those are still there. Still demanding payment. And Ethiopia's foreign reserves are so low that they cannot even publish the number anymore without triggering mass panic. Pakistan, Egypt, Tunisia, Ecuador, Suriname. The list goes on. Every one of these countries is in Tier 3. Every one of them is paying interest rates north of 10%, some north of 15% on their external debt. And every one of them is running out of dollars. Now here is why this three-tier structure is terminal. In a normal market, arbitrage would close these gaps. If Zambian bonds trade at 18 cents in the distressed market but 32 cents on the screen, smart money would buy at 18 and sell at 32. They would make 14 cents risk-free. That trade would push the 18 up and pull the 32 down until they met somewhere in the middle. But that is not happening. You know why? Because you cannot arbitrage between a price that exists only on a screen and a price that requires you to actually hold defaulted paper for a decade of litigation. You cannot arbitrage between a liquid market and a frozen market. And you cannot arbitrage between countries that already defaulted and countries about to default. Because the moment you buy the Tier 3 debt hoping to sell before default, the default happens and you are trapped. The bridges are burned. The markets have separated. And there is no force, no mechanism, no amount of money that can bring them back together. This is not a dislocation. This is not a panic. This is a permanent fracture. Now, let me take you to the number that explains everything. The number that makes all of this inevitable. $741 billion. That is not a loan. That is not how much developing countries owe. $741 billion is how much more developing countries paid out in debt service, in principal and interest, than they received in new financing during the years 2022, 2023, and 2024. $741 billion more going out than coming in. Think about that number. Let me say it again so it sinks in. $741 billion. Let me spell it out for you in pieces so you understand the magnitude. During those 3 years, developing countries made debt payments totaling well over $1 trillion. Over $1 trillion. They paid interest to bondholders in New York and London. They repaid principal to Chinese policy banks. They serviced loans from the World Bank and the IMF. $1 trillion flowing out. But during those same 3 years, how much new money flowed in? How much did private creditors lend? How much did China disperse in new loans? The answer is less. Significantly less. The difference between what went out and what came in equals $741 billion. That is the net drain. That is money that left developing countries and never came back. Let me break this down into simple mathematics, because this is the core of everything. If you're a developing country, you need dollars to operate. You need dollars to buy oil. You need dollars to import food and medicine. You need dollars to pay your external debt. Where do those dollars come from? 3 sources. Source number 1, exports. You sell goods to the world, you earn dollars. Source number 2, foreign investment. Companies and investors send you dollars in exchange for equity or bonds. Source number 3, borrowing. You issue new debt. You receive dollars up front. For 40 years, this system worked because source 3 was always bigger than the amount going out in debt service. You would pay $100 billion in debt service, but borrow $120 billion in new debt. Net result, $20 billion flows into your country. You have more reserves at the end of the year than the beginning. The system is sustainable. But starting in 2022, that equation reversed. Suddenly, developing countries, as a group, were paying out more than they were borrowing. The net flow turned negative. $741 billion negative over 3 years. That is an average of $247 billion per year bleeding out of the developing world. Now you need to ask, where did that $741 billion go? It did not vanish. It flowed somewhere. Let me tell you exactly where. It flowed to private creditors, commercial banks, hedge funds, asset managers. Since 2022, private creditors have extracted nearly $13 billion more from the poorest countries than they provided in new loans. $13 billion net extraction from countries that can barely feed their populations. Let that sink in. The countries that need money the most are actually sending money to some of the richest institutions on earth. BlackRock is not bailing out Ghana. Ghana is paying BlackRock. It flowed to China through Belt and Road loans that are coming due, through commodity-linked financing deals where countries must repay in dollars even when commodity prices fall. China lent aggressively for 15 years. Now China is collecting. And when countries cannot pay, China is not restructuring. China is seizing ports, seizing infrastructure, taking physical assets in exchange for debt. It flowed to multilateral institutions, the World Bank, the IMF. Even they, despite their stated mission to support development, even they collected hundreds of billions in debt service during this period. Yes, they also lent. They lent $51 billion more than they collected. But think about the absurdity. The World Bank is supposed to be helping poorer countries develop. Instead, poor countries are sending cash back to Washington just to service old loans while begging for new loans to replace the cash they just sent. But here's where it gets exponentially worse. Because that $741 billion that left developing countries, that was not extra money sitting around. That was money that came from reserves. Money that should have been used to stabilize currencies, to import food, to pay for fuel. Instead, it went to debt service. So now you have countries with depleted reserves facing the same debt service obligations next year. Only now, they have less money to pay with. So what do? They deplete reserves even more, or they default. Those are the only two options. And when you deplete reserves below a critical threshold, below the level needed to cover maybe 60 days of imports, the currency collapses. Inflation explodes, and you default anyway. You just default after destroying your economy first. This is not a liquidity crisis. Liquidity crisis means you are temporarily short on cash, but fundamentally solvent. This is a solvency crisis. These countries cannot pay, not because they are mismanaging cash flow. They cannot pay because the debt is mathematically larger than their capacity to generate dollars. The World Bank called this a 50-year high. 50 years. That means this drain, this net outflow from poor to rich, is the worst it has been since the 1970s. The last time it was this bad was right before the Latin American debt crisis. Right before Mexico defaulted in August 1982 and triggered a decade-long depression across South America. History is rhyming. The same pattern, the same mechanics. Except this time, it is not just Latin America. This time is Africa. It is South Asia. It is the Caribbean. It is everywhere at once. And this time the dollar is not stable. The Federal Reserve is not cutting rates to ease the pressure. If anything, the Fed kept rates higher for longer, which made dollar debt more expensive, which accelerated the drain. You are watching the setup for the largest wave of sovereign defaults since World War II. And it is not coming. It is here. It is happening right now. The defaults have already started. Zambia, Sri Lanka, Ghana. Those are the first dominoes. The question is not if more will fall. The question is how many and how fast. Now I want to drill deeper into that $13 billion number I mentioned. $13 billion extracted from the world's poorest countries by private creditors since 2022. Because when you examine who those creditors are and how they operated, you see this was not an accident. This was a deliberate strategy. Here's how it worked. Go back to 2010, 2015, 2020. Interest rates in developed markets were zero, sometimes negative. If you were a pension fund, an insurance company, a hedge fund, you needed yield. You needed return. Where did you find it? Emerging markets, frontier markets, the riskiest sovereign borrowers. Countries like Zambia, like Sri Lanka, like Ghana were issuing dollar-denominated bonds at 7%, 9%, 12% yields. That looked incredible compared to U.S. Treasuries at 2%. So the money flooded in. Billions and billions of dollars chasing those high yields. The borrowing countries were thrilled. They could access cheap money, at least cheap by their standards. They used it to build infrastructure, to fund budgets, to avoid painful reforms. Everyone was happy. The creditors earned high returns. The countries got financing. And credit rating agencies blessed the whole party by giving these bonds investment grade or near investment grade ratings. But those high yields were high for a reason. They were high because the risk was enormous. The risk that these countries could not actually afford the debt. The risk that when global conditions changed, when the dollar strengthened, when commodity prices fell, these countries would be unable to pay. That risk was always there. It was priced into the yield. But everyone ignored it because the money was good. Then 2022 arrived. The Federal Reserve started raising interest rates. Aggressively. Fastest tightening cycle in 40 years. The dollar surged. Suddenly, every dollar of debt that these developing countries owed became 20%, 30%, 40% more expensive when measured in their local currencies. The debt ballooned overnight. At the same time, commodity prices collapsed from their 2022 highs. Oil, copper, agricultural goods, everything that developing countries export to earn dollars, the prices fell. So their revenues dropped just as their debt service costs exploded. Classic scissors crisis. Costs up, revenues down. The gap becomes unbridgeable. So what do the private creditors do? Do they say, we understand, we lent too much, let us restructure early and take a haircut? No, they did the opposite. They accelerated extraction. They pulled out every dollar they could while they still could. They stopped rolling over short-term debt. They refused to participate in new issuance. They triggered acceleration clauses when countries missed payments. They hired lawyers to seize assets. And the result of all that aggression? $13 billion net extraction from poor countries since 2022. $13 billion more taken out than put in. Let me put that in context. $13 billion could vaccinate every child in sub-Saharan Africa. It could provide clean water to 200 million people. It could build power grids for entire nations. Instead, it went to creditors, to funds managing rich people's money. But here is the truly perverse part. Those same creditors, the ones extracting $13 billion, they knew the countries could not sustain the payments. They knew defaults were coming. That is why they were extracting. They were playing a game of musical chairs. Get your money out before the music stops. Because once it stops, once the default is declared, your bonds are worth 18 cents on the dollar. So the extraction itself guaranteed the defaults. By pulling out money, by refusing to refinance, the creditors created the very crisis they were trying to escape. They turned a difficult situation into an impossible situation. And now they are sitting on defaulted bonds worth a fraction of face value, hiring lawyers to fight over scraps. They would have been better off restructuring early. But greed and fear do not produce rational outcomes. They produce this disaster. While private creditors extracted, who stepped in? The multilaterals, the World Bank, the IMF, the regional development banks. They pumped in $51 billion more than they collected during 2022 and 2023. $51 billion. That sounds like a lot. That sounds like a rescue. But think about what that actually means. It means the multilaterals are acting as lender of last resort. They're the only institutions willing to lend to these countries. And why are they lending? Not because it is good business. They're lending because if they stop, the entire system collapses. If the World Bank stops lending to countries that cannot access private markets, those countries default immediately. Then they cannot import food. Then you get famine. Then you get political collapse. Then you get refugee crises. Then the problem becomes everyone's problem. So the multilaterals are stuck. They have to keep lending into a black hole. They have to keep providing dollars to countries that will never be able to repay. They're extending and pretending, hoping that somehow, magically, these countries will grow fast enough to outrun their debt. But that is not happening. Growth is anemic. Debt is compounding. And every new dollar lent by the World Bank is a dollar that will eventually have to be written off. The chief economist of the World Bank said it himself. He said multilateral institutions have become the lender of last resort for poor economies, a role they were never designed to serve. That reflects a dysfunctional financing system. His words, dysfunctional, not broken, not in crisis, dysfunctional. That is diplomatic speak for completely screwed. Now, let me take you to the bond market itself, because this is where you can see the panic in real time. Not in news articles, not in speeches, in yields, in the price the market demands to lend money. Start with Republic of Congo. Central Africa, oil exporter, small population. They went to market recently to issue new debt. They needed dollars, desperately, so they offered a bond. And you know what yield the market demanded? 13.7%. 13.7. Let that number sit in your mind. 13.7% annual interest. For a sovereign government. That is not a bond. That is a cry for help. That is a country so desperate for cash that they are willing to promise returns that they absolutely cannot sustain long term. Think about the mathematics. If you're paying 13.7% interest on your debt doubles every 5 years just from compounding interest. Even if you never borrow another dollar, even if you pay down some principal, the interest alone is eating you alive. You would need nominal GDP growth of 15%, 20% just to keep the debt to GDP ratio stable. And Republic of Congo is not growing at 15%. Nobody is. So why do they issue at that yield? Because they had no choice. They have bills to pay. They have an election coming. They need to keep the lights on, literally. Their infrastructure for electricity and water is crumbling. Their population is restless. So they borrowed at 13.7%, knowing it is unsustainable. Knowing that in 2 years, 3 years, they will be back in the same crisis. But 2 years is later. Right now, they need the money. And who bought that bond? Who would lend money at 13.7% to a country that still has debt to GDP of 95% despite just completing a debt restructuring in November 2024? Vulture funds, distressed debt specialists, people who are not lending because they think Congo will repay. They are lending because they think they will make 30% or lose everything, and they like those odds. It is a casino bet, not a bond investment. Republic of Congo is not an outlier. They're the norm now. Look across frontier markets, across the countries in Tier 3 that have not defaulted yet. Their yields are uniformly above 10%. Many are above 12%. Some are approaching 15%. This is mathematically unsustainable. You cannot run a modern economy where the government is paying double-digit interest rates on its debt. That means every dollar you collect in taxes, a huge portion goes to interest before you can spend a single cent on schools, hospitals, roads, police. You are a debt servicing machine that happens to have a country attached. And the cruelty is that these high interest rates make default inevitable. If Congo was borrowing at 4%, they might be able to manage. They could grow, pay down debt over time, stabilize. But at 13.7%, no chance. They're on a glide path to default. The only question is when. 2027? 2028? It is coming. The sovereign crisis is bleeding into corporate debt. Look at Brazil. Brazilian companies, especially in sectors that face demand slowdown and margin pressure, they're collapsing under debt loads. Why? Because Brazil's central bank kept interest rates high to fight inflation. Orthodox monetary policy. Textbook. But orthodox policy in a high-debt environment is lethal. When you raise rates to 12%, 13%, you kill the corporate sector. Companies that were manageable at 6% rates are insolvent at 12%. Their balance sheets, which looked stable, suddenly look crippled. They cannot refinance. They cannot service existing debt. They default. And corporate defaults feed back into sovereign stress. Because when companies fail, tax revenues fall. Unemployment rises. The government has to spend more on social programs while collecting less in taxes. The fiscal deficit widens. The sovereign borrowing requirement increases. And the sovereign has to go back to market asking for money at even higher yields. It is a death spiral. The analysts are projecting that sovereign defaults will rise in 2026 from zero this year. Zero. That is the baseline. That is how bad things already are. They are expecting it to get worse. But they also say defaults will remain below the historical long-term average of 1%. 1% of countries defaulting per year. Let me translate that reassurance for you. They're saying, yes, more countries will default, but not too many. Maybe 2 or 3 instead of 0. Maybe we see another Ghana situation. Maybe we see another Ethiopia situation. But it will not be systemic. It will not be a cascade. That projection is fantasy. Because defaults are not linear. They do not happen one per year in a nice, orderly fashion. They cluster. They cascade. One country defaults, and suddenly creditors look at the next 20 countries with similar profiles, and they panic. They pull money out. They refuse to refinance. And those 20 countries, which might have survived if credit kept flowing, they default too. Not because their fundamentals changed overnight. Because the market changed overnight. We are at the beginning of that cascade right now. The defaults that have happened, Zambia, Sri Lanka, Ghana, those were not random. They were the weakest links. The countries with the worst fundamentals breaking first. But the stress is spreading. The countries in Tier 3, they're all facing the same pressures. And when one more falls, when Pakistan or Egypt or Tunisia announces they cannot pay, the panic will intensify. More will follow, faster. We need to talk about liquidity, or rather, the complete absence of it. Because here is something the financial media will not tell you clearly. Most emerging market sovereign bonds have no liquidity right now. None. You can see prices on screens, but you cannot trade at those prices. The market is frozen. Liquidity means you can buy or sell quickly at a known price without moving the market too much. If a bond is liquid, I can sell $10 million worth and get the quoted price or very close to it. The transaction happens in minutes. Settlement in 2 days. Easy. But if a bond is illiquid, everything breaks down. I want to sell 10 million. I call dealers. Nobody picks up. Or they pick up and say, let me get back to you. Or they give me a price 20% below the screen quote. Or they say they can only take 2 million, not 10 million. The market is not functioning. That is the state of emerging market sovereign debt right now. The market is not functioning. Look at Sri Lanka. Their bonds show a price of 47 cents on the dollar. But the last actual trade happened 8 months ago. 8 months. There is no market. There is just a number that a dealer marks his position at for accounting purposes. If you try to sell, you would have no idea what price you would actually receive. Maybe 40 cents. Maybe 35 cents. Maybe nobody bids at all. Why is liquidity gone? 3 reasons. First, the banks that used to make markets in these bonds, they have pulled back. Regulations, after the financial crisis, made it expensive for banks to hold inventory of risky bonds. So they stopped. They used to keep millions of dollars of emerging market debt on their balance sheets, so they could sell to clients instantly. Now they keep almost nothing. If you want to sell, they have to find a buyer first. That takes time. Sometimes it takes forever. Second, the big asset managers who used to buy emerging market debt, they're all selling at once. We're trying to sell. They looked at their portfolios in late 2024 and saw defaults coming. So they decided to exit. Get out before it gets worse. But when everyone is selling and nobody is buying, there is no market. You have supply without demand. That means price discovery breaks down. You cannot find a real clearing price because transactions are not happening. Third, fear. Pure fear. Even investors who might be interested in buying at distressed prices, they are hesitating because they saw what happened to holders of Zambian debt. They saw years of litigation, pennies on the dollar recovery. They think, why catch a falling knife? Why buy now when it might drop another 20 cents? Why not wait until the restructuring is announced, until there's clarity? But that waiting, that hesitation, it removes buyers from the market. And without buyers, there's no liquidity. So what you see on Bloomberg, those prices for emerging market sovereign debt, many of them are phantom prices. They're not based on recent transactions. They're based on models, interpolations, dealer marks, educated guesses, but they are not real. You cannot actually transact at those prices. This creates a dangerous illusion. Pension funds, insurance companies, they hold these bonds on their balance sheets. They mark them at the screen price. 47 cents for Sri Lanka, 32 cents for Zambia, whatever Bloomberg says. And their auditors accept those marks because there is a Bloomberg quote. But if they actually tried to sell, if they needed cash and called their broker to liquidate the position, they would discover the real price is much lower, maybe catastrophically lower. The value on their balance sheet is fiction. It is a number that exists only because nobody is testing it by trying to sell. Now imagine what happens if one of these large holders is forced to sell. Maybe they have redemptions. Maybe their risk management system flags the position as too large. Maybe a regulator tells them to reduce exposure. They do not want to sell. They know the price will be terrible, but they have no choice. So they start calling dealers, offering to sell, and the price collapses. Because the dealers know the seller is desperate. They know this is forced selling. So they bid 20 cents for a bond quoted at 32 cents. And the seller, because they're truly forced, they accept. The transaction happens. Bloomberg updates the price. Now the screen shows 20 cents, not 32 cents. What happens next? Every other holder of that bond now has to mark their position down to 20 cents. Their losses crystallize on paper. Their risk systems flash red. Some of them get forced to sell too. More supply hits the market. The price drops to 15 cents. Then 10 cents. It is a cascade, a liquidity death spiral, the kind that happened with mortgage securities in 2008. We are standing on the edge of that spiral right now in emerging market sovereign debt. The market is frozen. Prices are phantoms. And everyone is hoping nobody is forced to sell. Because the moment one big foreseller appears, the entire structure collapses. And then you will see the real prices. The prices that reflect zero liquidity, maximum fear, and no hope of repayment. That is when Tier 3 becomes Tier 1 overnight. When countries that look like they might survive suddenly trade like Zambia. 18 cents on the dollar. Not because their fundamentals changed, because the market panic changed. And in a zero liquidity environment, panic moves prices to unimaginable levels. Prices that do not reflect reality, but that become reality simply by existing. The sovereign debt crisis is not isolated to governments. It is spreading through the entire institutional investment complex. Because the entities that bought these bonds, the ones holding them on their balance sheets at phantom prices, they're some of the largest financial institutions in the world. Start with pension funds. Public pension funds, especially in the United States and Europe, they have billions of dollars allocated to emerging market debt. Why? Because their actuaries assume they need to earn 7%, 8% annual returns to meet future obligations, to pay retirees in 2030, 2040. But how do you earn 7% in a world where U.S. Treasury bonds yield 4%? You take risk. You buy emerging market sovereign debt at 8% yields. You buy corporate bond from Brazil and Turkey. You chase return. For years, this strategy worked. The bonds paid their coupons. The returns added up. The pension funds looked healthy. But now those same bonds are defaulting or about to default. The coupon stopped. The principal is impaired. The 8% return turned into a 40% loss. And the pension funds cannot sell because there is no liquidity. Because if they try to sell tens of millions of dollars of these bonds, the price would collapse. So they sit, they hold, they mark the positions at stale prices and hope somehow the countries restructure quickly and they get most of their money back. But restructuring takes years. Zambia defaulted in 2020 and still has not finished restructuring. Ghana, Sri Lanka, same story. So these pension funds are going to sit on these impaired bonds for years, during which time they earn nothing. No coupons, no return. And when they finally restructure and recover 50 cents on the dollar, they will have locked in massive losses. What does that mean for retirees? It means underfunded pension plans become more underfunded. It means states and municipalities have to increase contributions to make up the shortfall. It means taxes go up or benefits get cut. The sovereign debt crisis in Africa and Asia is going to hit retirees in California and Ohio. That connection is not obvious until you trace the ownership of the bonds. Insurance companies have the same problem. They bought emerging market debt for yield. They needed higher returns to match their long-term liabilities. Now they're sitting on defaulted or soon-to-default bonds. Their balance sheets show assets that are not really assets anymore. They are claims in a bankruptcy proceeding. Regulators are starting to notice. They are asking insurance companies to increase reserves against emerging market exposure, to mark down the value. That reduces capital ratios. That makes the companies look weaker. In extreme cases, it could threaten solvency. We have not seen an insurance company fail because of emerging market debt exposure yet. But if the defaults accelerate, if Tier 3 collapses in a Tier 1, we will. Hedge funds are in a different position. Many of them bought emerging market debt at distressed prices precisely because they expected defaults. They were not surprised by Zambia or Sri Lanka. They were waiting for it. They bought bonds at 30 cents, expecting to recover 50 cents in restructuring. That is their business model. But even the distressed debt specialists are getting nervous now because the restructurings are taking too long, because the recovery rates are lower than expected, because too many countries are defaulting at the same time. There is not enough capital in the distressed debt world to buy every defaulted bond from every emerging market. The market is getting saturated. And some hedge funds on the wrong side. They were short, betting on defaults. Good trade, but they covered too early. Or they bet on the wrong countries. Or they expected defaults in 2025 and they happened in 2024, so they missed the move. Even in a crisis, even when the directional call is right, timing and execution matter. And plenty of smart money is losing money right now. The question everyone should be asking, but almost nobody is, how big is the total exposure? How many trillions of dollars of institutional capital are tied up in emerging market sovereign and corporate debt? And how much of that is at risk? The Bank for International Settlements estimated total emerging market debt, public and private, at over $90 trillion. $90 trillion. Obviously, not all of that is at risk. Most of it is domestic debt in local currency. But the external debt, the dollar and euro-denominated debt, that is measured in trillions. Low single-digit trillions, maybe $2 trillion, $3 trillion of external debt held by foreign creditors. If 5% of that defaults, that is $100 billion in losses. If 20% defaults, that is $400 billion, $600 billion in losses. Spread across pension funds, insurance companies, asset managers, hedge funds, banks. Not enough to bring down the global financial system. Not like 2008, but enough to cause serious pain. Enough to force bailouts. Enough to matter. And here's the kicker. Those losses are coming at the same time that banks are stressed from commercial real estate. At the same time that sovereign debt in developed markets is exploding. At the same time that geopolitical risk is maximum. It is not one crisis. It is a polycrisis. Multiple stresses hitting the financial system simultaneously. That is when things break in unexpected ways. We are now inside a 72-hour window that will define the next decade of global finance. This is not hyperbole. Let me walk you through exactly what is happening right now, today, and what will happen over the next 3 days. It is Tuesday, January 13th. Financial markets are open. Trading is normal. Emerging market debt is pricing at whatever phantom levels we discussed. Pension funds are marking their positions at stale quotes. Nobody is panicking yet. But behind the scenes, in the offices of central banks and finance ministries across the developing world, they're looking at calendars. They're looking at debt payment schedules. And they're looking at reserve balances. And they're doing math. The math that tells them whether they can make the next payment. For at least 3 countries, maybe more, the answer is no. They cannot make the payment. Not without depleting reserves below the absolute minimum. Not without triggering a currency collapse. So they're making phone calls, encrypted lines to the IMF, quiet conversations with their largest creditors, preparing the ground for an announcement nobody wants to make. Wednesday is when the leaks start. They always do. Someone in a finance ministry tells someone at a local bank. Someone at the IMF tells someone at a hedge fund. The information spreads in whispers. No official announcement. But people start to know. And when people start to know, they start to position. If you're a holder of bonds from country X and you hear whispers that country X might announce a payment suspension, what do? You sell. Immediately. You do not wait for the official announcement. You sell Wednesday morning into whatever bid exists. Take your loss. Move on. That selling pushes the price down. Other holders see the price falling. They do not know about the whispers, but they see the price action. They get nervous. Some of them sell too. The volume increases. The price falls further. By Wednesday afternoon, the bond is down 15%, 20%. No news. Just trading. Just positioning. The finance minister of country X sees this. He sees his bonds collapsing. He knows the leak is out, and he realizes he has lost control of the narrative. The market knows before he has announced. So what does he do? He accelerates the announcement. He calls an emergency press conference for Wednesday evening or Thursday morning. He cannot wait until Friday like he planned. The market forced his hand. Thursday morning, the finance minister stands in front of cameras and microphones. He reads a prepared statement. He says his country, due to extraordinary circumstances beyond its control, cannot make the scheduled debt payment due next week. He says they are requesting a standstill with creditors. He says they are committed to negotiating in good faith. He says this is temporary. He says everything will be fine. The bonds collapse. Whatever they were trading Wednesday, cut in half. If they were at 40 cents, they'd go to 20 cents. If they were at 50 cents, they go to 25 cents. Trading is chaotic. Dealers pull quotes. Nobody knows what price is real. Volume spikes. And then volume disappears because nobody wants to sell at the new lower price and nobody wants to buy until it stops falling. But does not stop because the announcement from country X triggers immediate reassessment of every other country in Tier 3. Pakistan, Egypt, Tunisia, Ecuador, Kenya. Investors look at their bonds and think, if country X just defaulted and country Y has similar debt to GDP, similar reserve levels, similar fiscal deficits, then country Y is next. So they sell country Y bonds too, even though country Y has not said anything, even though country Y might actually be fine. Perception becomes reality. By Thursday afternoon, there are 5 countries whose bonds are in freefall. Not 1, 5. The cascade has started. And every analyst, every economist, every talking head on financial television is asking the same question. Who is next? How many more? Is this contagion? Friday, the policy response begins. The IMF issues a statement. They say they are monitoring the situation closely. They say they stand ready to provide support to countries facing liquidity pressures. They announce an emergency board meeting for next week to discuss expanded facilities. The World Bank issues a similar statement. The G20 finance ministers hold an emergency call. They release a communiqué expressing solidarity with developing countries and reaffirming their commitment to the multilateral financial system. It is all diplomatic language. It means nothing. Because words do not add dollars to reserve accounts. Words do not make debt payments. What matters is actual money. And on that front, the response is slow. Because every G20 country has its own problems. The United States is dealing with a fiscal crisis. Europe is in recession. China is managing its own debt bubble. Japan is wrestling with inflation. Nobody has spare trillions to bail out developing countries. Nobody wants to be the one to commit money first. So the statements are released. The calls are held. The meetings are scheduled. And nothing actually happens. No emergency lending. No debt relief. No bailout. Just talk. And the markets watch this. They see the lack of action. And they conclude that the policymakers have no plan. That it is every country for itself. And that realization triggers more selling. By Friday close, 10 countries have seen their bonds fall by more than 20% in 3 days. 3 of them have announced payment suspensions or restructurings. 2 more are rumored to be next. The emerging market debt index is down 12% for the week, the worst weekly decline since the COVID crisis in March 2020. And this is just the beginning, because the announcements this week will lead to credit rating downgrades next week, which will trigger forced selling by institutional investors who have mandates to hold only investment-grade debt, which will push prices lower, which will stress more countries, which will lead to more defaults. The feedback loop has started, and it accelerates from here. We are witnessing a transfer of wealth, not the kind they tell you about in economics textbooks, not a smooth adjustment where capital reallocates efficiently. We are watching wealth vanish, disappear, evaporate. Pension funds in the United States and Europe hold hundreds of billions in emerging market debt. That debt was marked on balance sheets at 70 cents, 80 cents, 90 cents on the dollar. Over the next year, that debt will restructure at 30 cents, 40 cents, maybe 50 cents on the dollar in the best cases. The difference is wealth destruction. $50 billion, $100 billion, maybe more, simply gone. Who loses? The pensioners, the retirees who thought their benefits were secure. They will get letters in 2027, 2028 telling them their monthly payment is being reduced, or their cost of living adjustment is being suspended, because the pension fund took losses and has to make up the shortfall. That is the wealth transfer, from retirees in developed countries to the void created by uncollectible debts in developing countries. But there is another side. The developing countries that default, do they win? No, they lose even more, because defaulting cuts you off from international capital markets. You cannot borrow, not for years, maybe a decade. You have to run fiscal surpluses. You have to live within your means. That means cutting government spending. That means austerity. That means unemployment, poverty, suffering. So nobody wins. Creditors lose money. Debtors lose access to credit. It is pure destruction. The only entities that profit are the lawyers and the vulture funds who specialize in picking over the carcass. They will make billions litigating these defaults, seizing assets, extracting whatever is extractable. But even their profits will be small compared to the total wealth destroyed. The political consequences will be profound. When countries default, governments fall. Look at Sri Lanka in 2022. Their default triggered mass protests. The president fled the country. The government collapsed. That pattern will repeat. Ghana, Pakistan, Egypt, whichever countries default next, they will see political instability, possibly regime change. And that instability creates other risks. Refugee flows, regional conflicts, opportunities for geopolitical rivals to gain influence. When a country is desperate, when its government is collapsing, it will take money from anyone. That means China. That means Russia. That means powers that are not aligned with the West stepping in with financing in exchange for strategic concessions. The debt crisis is not just an economic story. It is a geopolitical realignment. The countries that default to Western creditors will increasingly look east for support. The post-World War II financial order, the Bretton Woods institutions, the dollar hegemony, all of it weakens with every default. All of it erodes as developing countries conclude that the Western financial system does not serve their interests. If you're an institutional investor holding emerging market debt, the answer is painful but clear. Cut your losses. Sell what you can sell. Take the hit now. Do not wait for restructuring announcements. Do not hope for bailouts. They are not coming. Get out while there is still some liquidity. If you're a pension fund or insurance company, you need to be honest with your stakeholders. Tell them the reserves are impaired. Tell them the returns will be lower. Tell them benefits might have to be adjusted. Do not hide behind stale marks and fantasy valuations. Transparency now is better than catastrophe later. If you're a policymaker, you need to prepare for contagion. Have emergency liquidity facilities ready. Have plans for how to stabilize domestic institutions if emerging market debt losses start threatening solvency. Have communication strategies ready for when pensioners realize their funds are underwater.